Instead of providing investors with a clear picture of the economy and stock market, the start of 2023 has brought more confusion for investors than answers. Everywhere you look, there's confusion. No one knows whether the Fed will increase interest rates further or push the stop button. Similarly, major economists and finance gurus are divided about inflation. Some are saying inflation's busting and we'll see deflation soon. But others are of the view that this is temporary, and in fact, inflation's going to get worse in 2023. Now, amidst all this chaos and confusion, I prefer listening to 92-year-old legend Warren Buffett. Buffett has been investing since he was 11 years old, and he's seen World War II, countless recession and inflation scenarios, and has been earning 20% annual return for the last 50 years, as compared to just a 10% annual return of the S&P 500 index. $1,000 invested in Warren Buffett's Berkshire Hathaway has become $24.6 million, and that too without any further investments. Let's make Warren Buffett our judge, and let's see how one should invest this year and earn a handsome return. Warren Buffett's philosophy is simple. Don't try to find one-hit wonders. Instead, invest in America, because companies can fail, but America will continue to rise and shine. The best way to invest in the future of America is to invest in index funds tracking American GDP. In this video, we're going to dig deeper into why Buffett considers the passive investment into index funds to be the most reliable strategy of making money on a regular basis.
Jack Bogle has probably done more for the American investor than any man in the country. Jack, there he is.
In 1976, Jack Bogle, the founder of Vanguard, created the first index fund to provide a low-cost investing method that valued the investor's interest over the company's interest. Index funds track the aggregate trends of a total market index, like the S&P 500, Dow Jones Industrial Average, or NASDAQ. It's a type of mutual fund or exchange-traded fund, or ETF. Indeed, it was a revolution in the mutual fund world, allowing investors to buy mutual funds that track the broader market. He did this with the overall intent to make investing easier and at a lower cost for the average investor. Unlike other investment funds, an index mutual fund is meant to work as a passive investment option rather than one that needs to be monitored against the market at all times. Index funds also tend to be lower maintenance because they offer a low-cost option with fewer management expenses. But later on, Jack Bogle believed that the actively managed funds underperform the market because of the higher operating expenses and management fees. However, from an individual investor's perspective, index funds are a more efficient and cost-effective way to reach strong returns on investment. Both history and the future have proved that Jack Bogle was right. The seminal research shows that 89% of the actively managed funds underperformed the S&P 500 in the last 15 years.
Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. The truth is it was not in the interest of the investment industry actually to have the development of an index fund, because it brought down fees dramatically. And as we've talked about, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all. He's put tens and tens and tens of billions into their pockets, and those numbers are going to be hundreds and hundreds of billions over time.
Arguably, Jack was of the view that a product should be provided for the regular investors, representing a diversified array across the market at a very low fee, winning returns closer to the actual market average. It can be seen by the performance of S&P since the commencement of Vanguard. The average annual return for the S&P has been 11.88% ever since. Contrary to this, you'll be surprised to know that since 1965, Buffett's stock selection has earned him a 20% annual return. So is it worth knowing why Buffett thinks that you should be an index fund investor?
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think.
Some people should not own stocks at all because they just get too upset with price fluctuations. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business.
So it can be seen in these Buffett clips that over the years, Warren Buffett's thoughts haven't really changed. So to be successful like Buffett, here's Buffett's rule. Never lose money. Stay rational and stick to your homework when researching businesses in which to invest. So to get insight of the business, one must spend time and efforts in studying business through different aspects. But apparently, it isn't possible to read each and every business in detail specifically when you're going to have a wide portfolio. There is consensus that despite the fact that stock selection is a challenging undertaking, it is possible. Nonetheless, time, commitment, and a reasonable temperament are required. These are characteristics that the majority of investors avoid, and this is the reason why Buffett opposes individual stock picking. Dollar cost averaging, on the other hand, is easier to commit to, and you can apply it efficiently.
The very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally, I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Buffett describes the passive investing method in this clip. He states, "You don't know enough to pick the winners and the winning time." Thus, passive investors examine market tracking assets and educate them to choose the optimal time to invest. Afterwards, they invest the same amount at regular intervals, which is known as dollar cost averaging. For instance, one of the passive investing techniques may involve investing $2,000 every 6 months in any investment that tracks the S&P 500. Alternatively, invest $1,000 quarterly in the NASDAQ index. Each investor may take a different technique, but they will all have a market tracking investment and a regular plan for spreading out their assets. They participate in the stock market, and they arrange their investments to be average on purpose.
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund. And I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved because all they're doing for you is buying that index. I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them.
Obviously, everything Warren said was true. Let us examine another aspect Buffett emphasized in this video, namely market diversity and regular investment. Yet, this is intended to be implemented for 20 to 30 years. In other words, it's accurate to assert that this is the only difficulty associated with passive investing. One must be committed to the time period necessary for the proper implementation of the investment strategy and the realization of a profitable return. You may have friends who are now passive investors. They inform you that their annual returns are 10%. It looks both exhilarating and technically incorrect. No doubt this strategy has historically offered a 10% average annual return, but people don't get 10% annually. Last year, someone got negative 20%. A year before, 27%. And a year before that, it was only 16%. Therefore, if you began this strategy in 2008, after a year, you'd be getting 10%, which is, in fact, negative 38%. Hence, if you're willing to enjoy the maximum benefits of passive investing, then you need to commit to a long enough time so that it entertains its investors with a dollar rate average. However, it can't be denied that passive investing has genuinely worked well in the long term.
The best single thing you could have done
on March 11th, 1942, when I bought my first stock, was just buy an index fund. Never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm, let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war, and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
In the real world, this is indeed the biggest pro for this strategy of passive investing. It has worked well historically without any doubts. It's already been stated that after 1957, the S&P 500 has successfully given 11.88% returns annually. And to achieve this, the investor didn't even have to use their brain, give any time, read through financial statements, watch CNBC, run discounted cash flow analysis, or sacrifice weekends to gather any knowledge. The only thing needed was, as Buffett said, to have faith in the American economy that it would move forward with time. Hence, American business will move with time as well. Passive investors, it is said, they shouldn't pay much attention to whatever's happening. This is the reason why most of the best active investors in the world always recommend passive investing. However, it must be kept in mind that risks are always involved if one is investing in the stock market, no matter what. In this video, we're not recommending anything to you that you should buy or sell. We're aware that market risk is always out there when we have diversified portfolios. Smart investors like Michael Burry also pointed out a concern that index investing is removing price discovery from the stocks. This implies that underlying business performance is not setting the market caps any further. The scenario is kind of bubble forming. Moreover, these index funds have been designed to buy the largest companies in specific markets. However, for instance, if you possess the stocks of the largest 500 in the USA, there are prominent chances that there may be companies that do not align well with your beliefs. Therefore, there are many things that you have to think about before announcing yourself as a passive investor. This video was focused on giving you an idea about passive investing and the reasons why the smartest and best investors like Warren Buffett recommend investors opt for passive investing. Time for the important announcement. Now you can join our community of 5,000 plus members and active stock market investors and receive the latest timely stock market and economy related updates, like what stocks to buy and what stocks to ignore or sell to save your portfolios. Economy and stock market related commentary and alerts are shared regularly on a weekly basis. You can also chat with me during market hours and ask me any questions. Join our community on Discord through Patreon. Upon becoming a member, you'll be able to enjoy some great perks. For example, you'll be able to receive proper buying and selling alerts for a wide range of potential stocks. We'll also share tips and alerts for option trading. You'll receive a weekly guide for stocks performance and updates with technical analysis. You'll be able to chat with over 5,000 like-minded members all the time. And you'll also be able to chat with me during market hours. I'd be delighted if you could join us. The link to join is given in the description below. Thanks, and see you on the other side.